So this is a condensed version of another video that has a bit more detail about this idea of this pass-through entity tax. Okay, so super high level here. We're just going to go through it quickly, and if you want more details, look at the other video, ask questions, things like that. Right? Um, Problem and solution. What is it? Why does this thing exist, and why would you want it? It's an elective tax. Why would you want to pay tax when it's an optional tax to pay? Think you wouldn't, right? But what happens is this is basically a tax that was created in response to the Tax Cut and Jobs Act of 2017. In that act, SALT, state and local taxes for individual taxpayers, was capped at $10,000 per year on the itemized deductions. It was one of the bad things. A lot of the other things were pretty helpful and good, but it was one of the big things a lot of people complained about. Since then, the states have been looking around to say, what can we do to free up the burden on our taxpayers like this and make sure that they're, we in our minds treated less unfairly. So they introduced this thing, pass-through tax. It's an entity level tax. That means it's the company that pays it. If you opt into it, optional decision, then your company would have to remit profit-based tax. So it's not based on what you as a person owe in taxes. Let's say, you as a company, as a person owe 20,000 in New York state tax because, you're married to someone who has $1 million salary or whatever it might be, some situation where your family income is up there. That's got nothing to do with pass-through entity tax. Pass-through entity tax looks at your entity, looks at its profit or income, depending on how calculating it, because they all have slightly different methods here. And they say, okay, we're going to apply a tax rate to that, which you'll pay by estimated payments through the year. And at the end of the year, whatever you've spent on this tax is going to be a credit that you can then use to reduce your state income taxes as a person, as an individual. So we did an example with the 100,000 profit of an S Corp, and this S Corp is owned by two people 50-50. At 6.85%, you spend about $7,000 in tax, remits it all over. By doing that, your profit's gone from 93 down to 93,000 or so. So it's gone from 100. It's a deduction for the tax. This is the change. It never used to be a deduction. If you paid taxes, personal taxes from your S Corp in the past, we had to say this was you just taking money out of it, putting in your pocket, and paying personal taxes with it. We say it was a shareholder draw. It's not with this method. It is no longer a draw. It is an expense. Okay. So your income is lowered, which is the goal of this, because it effectively is like having a larger Schedule A deduction. A side benefit is you don't even need to itemize anymore, because if you were to take the standard deduction and do this, let's say you don't even have a huge amount of New York tax and your profit from the company is only 50,000 or so. By using this, you're making sure that you get the best of both worlds. You're deducting income tax, personal income tax paid at the state level, and you're taking a larger standard deduction, which again is not the intention of the Tax Cuts and Jobs Act. So the state's saying, hey, we think it's unfair, we're going to level the playing field. Maybe they've over leveled it with this, but take it for what it is. Okay. So that is essentially it. It is an elective tax that we can opt into with the purpose of increasing business expenses at no extra cost to you. So you get a free business expense that then lowers your federal tax liability. The state gets paid what the state gets paid. They're smart about this. They don't change how much you owe the state. If you owe the state 20,000 state tax, you're still going to pay them 20,000 state tax. It'll just be that some of it came from the fact that you paid by the company. They're still going to get their full money. The only person who loses out is feds, and the only person who gains is the shareholder. So it is a state design plan to put more money into the state resident's pocket at the expense of the federal government. So sounds like the sort of thing that we might like to have a piece of. There's a couple of caveats, a couple of rules, and everything else. There's a bunch of them, but and the document goes on to explain some situations. Talks about why you do an S corp anyway. This is a step up from an S corp. So you first got an S corp, then you got a pass-through tax election in those states. Also lists the states that are, kind of in the program now. Those are adopting legislation. Those are about to. A couple are going live on January 1st. New York, that is actually live retroactive. If you elect by 10/15 of this year, you can go back to January 1st. Okay, so there's a lot going on with it, and it's really moving fast because states are realizing this is a great way to increase the number of dollars that stay in the state. It's not necessarily all about their revenue because their revenue is consistent, but the taxpayers of the state will be wealthier, and therefore they'll have more money to spend in the state rather than sending it back to Uncle Sam.